Welcome back to the Financial Freedom Show. My name is Rob Berger. In today's episode, I have a special guest, Christine Benz from Morningstar. Christine, how are you today?
I'm good, Rob. How are you?
I am well. Thanks for taking a few minutes out of your no doubt busy day. And I'll be honest, this there's a lot of self-interest for me personally in this interview because I know you've written a lot about the bucket strategy. And I tried to implement it 2 years ago when I thought I was going to retire, and I ran into all kinds of problems. I'm hoping you can help me out with that. I want to talk about the 4% rule, but I kind of want to begin with just some current events. And the first is, Congress now has passed. I don't know if President Biden has signed it yet, but he's passed the stimulus. I guess it would be it's actually like the fifth or sixth stimulus bill, I think, but it's obviously a big one, 1.9. I started to say billion, 1.9 trillion. So is this going to trigger inflation? And where is inflation? Why don't we have any right now? Any ideas on that?
Yeah, that's the concern that this stimulus package, combined with the fact that we seem to be climbing our way out of the pandemic anyway, that combination could lead to some level of inflation. I do not know the answer about whether that will happen or not. I do remember, though, coming out of the last financial crisis in sort of the 2008, 2009 period, we also heard a lot of alarm bells going off during that period about inflation being nigh. And guess what? It didn't really materialize. We went on to have a decade of very low inflation. One thing I've been thinking a lot about, Rob, though, is whether, even though consumer prices haven't necessarily been going up, maybe we're seeing inflation in the form of investment assets going up and up and up. Yields, at least until very recently, generally trending down because demand for fixed income assets has been high. So I just happen to wonder whether we've had this sort of K-shaped recovery that everyone has talked about, whether we could see potentially inflation shaped like that as well, where you don't necessarily see heightened demand for consumer products, but you see heightened demand for investment assets. So that's something that I've been wondering about.
Yeah, that reminds me of what Warren Buffett has said. He sort of views interest rates like gravity as interest rates go down, asset values are going to go up on everything from, Bitcoin to baseball cards, really.
Right.
And of course, as interest rates go up, the values will go down. And so I guess it's asset inflation. Although it's certainly going to reverse, I would think, at some point. Just a question, right? The question is when.
Right.
And I think a lot of people are surprised that we can print so much money and not have inflation. And I think that's important for the 4% rule, right? Because a lot of folks say it really isn't as applicable today because yields are so low. And I know you've done a lot of your own research, you've interviewed a lot of folks in this area. What are you seeing? Do you think the 4% rule, as William Bengen envisioned it, in 1990, I think it was,
Right.
or something like that?
It was.
Yeah. Is it still valid today, or do we have to change it because of the low yields?
Well, certainly when you look at that combination of low yields and low equity valuation or high equity valuations, what that portends is kind of thin gruel for us investors over the next decade, because current yields are an incredibly good predictor of what you're likely to earn from bonds over the next decade. Well, look at where we are today. You're lucky to get, 2% on a core intermediate term bond fund. Cash yields are even lower than that. So there's your return, more or less. And equity returns, US equity returns, I don't know, we've had a great decade already. So you'd probably want to set your expectations there nice and low, at least for the next decade. And so when I talk to my colleague David Blanchett, who focuses on retirement research for us, when I've spoken with Wade Pfau, who is another one of the leading lights in retirement research, their view is that it really does make sense for retirees to bring it down if they are using the Bill Bengen type of withdrawal strategy. And I think it's important to point out, Rob, that is a very specific strategy. I think sometimes people hear 4%, and they think that means that we're telling them that they will live on 4% of their portfolio year in and year out. And so I think it's important to underscore what it means, which is that you take 4% in the first year of retirement, and then inflation adjusts that dollar amount. It's not like you are taking 4% in perpetuity. So my bias is toward strategies that afford you a little bit more flexibility, if you can be flexible, rather than saying, I definitely need this sort of smooth consumption pattern throughout my retirement years. If you can be a little bit flexible and say, well, if I have a lousy market environment, I'm willing to rein in my spending, if in exchange that means potentially I can spend a little more in up markets. Right. And so I would prefer that most retirees, to the extent that they can, kind of land there with a more flexible strategy. But of course, your ability to live with a more flexible strategy really does get to level of wealth. If you have more wealth, you probably have more discretion to be flexible in your spending. If your plan is really tight, me telling you to drop your spending from $40,000 to $30,000, that's a big deal, right? That there's a lot of quality of life adjustments that get cut out.
Yeah, and there's a lot there. I tend to take the devil's advocate. Play the devil's advocate on the 4% rule. I'm still very bullish on that rule, in part because of low inflation. Yields are low, equity valuations are high, and Michael Kitces has done some great work on mapping equity valuation to the 4% rule. But of course, in sort of the worst case scenarios, it still comes out to 4%. That's like the worst case, right? And yields are low, but your adjustments each year are so small because there's virtually no inflation. And what I think it's going back to what in the 1800s, the worst year to retire was 1966, right? That was Bill Bengen found that year, and then Kitces took it back further, still 1966. So I guess we're kind of waiting for the next year that's going to break the record, right?
Right.
And what's the next year that's going to be the worst? But at least until inflation starts to get crazy, and I remember, getting a 6-month CD at 16%, which I guess ages me. But I'm a little more bullish on the 4% rule, but I guess time will tell. The interesting thing that you alluded to beyond that is like the guardrail approach or some sort of dynamic spending, because I've never met someone in retirement who says, I follow that 4% rule year in and year out without any variation. I don't know that anyone really lives that way. So my question then is, have you found any dynamic spending rules or guardrails? I know Guyton Klinger is out there. Kitces has done his. There's even sort of the Yale spending rule. You could get fancy and talk about how endowments do it, right? But do you have any sort of guardrails that you think are very simple that folks can apply, or that you think are probably a little more practical and useful?
Well, I do like Jonathan Guyton's approach quite a bit, and have spoken with him at length about what he calls the guardrails strategy, the Guyton Klinger approach that you referenced. But Rob, you're right that all of these flexible withdrawal strategies, or variable withdrawal strategies, whatever you want to call them, do get a little bit complicated. And so I think that is where an advisor can add a lot of value to help a client kind of figure that out. Yeah. For people who want, I would say, an easy to digest approach, Vanguard had a research paper probably like 8 years ago now that was a version of the guardrails or the ceiling, and I think they called it ceiling and floor approach. Yeah. I felt that paper was pretty intuitively explained, but you're right that they can get complicated. One maybe simpler strategy that is flexible but does move up a little bit as the years go by is just an RMD, required minimum distribution type method. And it addresses two things really elegantly. One is that it tethers your withdrawals to your balances, which is what we're talking about, that you want to be sensitive to what's going on in your portfolio and in the market. So the RMD method, because it references your portfolio from year end previous year, it does that, but it also factors in age. So it lets you take more as you age. That is a uber simple approach that I think gets at some of these issues as well. So that would be one thing to consider.
That's a good one. I've heard don't take an inflation adjustment in any year where the market's down, or don't ever take out more than 6% of your portfolio, and even set a floor, because you might not want to overspend, but you might not want to underspend either, right? So always take out at least 4% or whatever. But I don't think I've seen any back tested data on those specific guardrails.
Yeah.
But yeah, the one on the RMD is interesting, because you're right. It kind of it takes in both factors, both age and your portfolio balance.
Right, right. You referenced Bill Bengen earlier, and I don't know if you saw his interview with Ben Carlson about inflation and the lack thereof. And his argument is, I think that 4% may be too low, given that people are not going to be necessarily taking those inflation adjustments. One point I always make in the context of inflation, though, is think about your personal inflation rate. Don't just pay attention to CPI when deciding whether inflation is something that you ought to be worried about. And for older adults, we know that healthcare spending is a bigger share of their consumption basket than it is the case for the general population. We also know that healthcare costs have been running higher than the general inflation rate for quite some time. So I think it's really important to take into account your own situation and your own experience in relation to prices, and how much you want to care and worry about inflation and factor it into your withdrawal system.
Yeah, that's a good point. I think there's inflation data that's specifically designed to apply to older folks as well.
It is the CPIE.
Yeah. So that's a good point. And also, your health spending goes up as you age. Studies show, obviously, though it can vary significantly, of course. Other spending tends to go down as you age. But I guess that just underscores your point that there's a reason there's personal and personal finance, right? So it can vary from person to person. Well, let's kind of, having talked about the 4% rule, let's go to the bucket strategy. And why don't we just start, if you can just give us your high level view of what it is and how it can help folks manage their money in retirement.
Sure. So I was introduced to the bucket approach probably more than a decade ago by Harold Avensky, who is a financial planner in Coral Gables, Florida, a really super thoughtful person on retirement planning. And we were talking about how he does it with his clients. And he mentioned to me that he uses this bucket structure where he sets aside cash for their near-term living expenses, a couple of years worth of their cash needs in very liquid accounts, and then he runs a balanced portfolio or whatever allocation he's using for the rest of their portfolio. And he mentioned that this really worked in a real world context in terms of helping his clients be peaceful with the long-term piece of their portfolio because they knew that their near-term income needs were set aside. And so for me, that was really attractive because we know that behavioral issues are so important. Even if you create a plan that looks absolutely optimized from every standpoint, if it doesn't really work and people can't really live with it, then it's not worth anything.
Yeah.
And so he mentioned that this seemed to work with clients. He'd call them in periods when the market was rough, and they would basically say it back to him. Harold, I know you've set up this cash bucket for us. I know that it means that we can still take that cruise we had booked next year. We can still continue to go out to dinner every Saturday night with our friends like we always do, that there were no disruptions to quality of life, and that gave his clients patience to sit with the plan. Yeah. So I started to think about that and started to think about, well, how could that look with a real portfolio? And I kind of arrived at a 3 bucket structure, which I've
Now
seen elsewhere as well.
if I can just interject, his
Sure.
strategy was a 2 bucket.
Just two
Okay.
buckets.
Okay.
And to be honest, he has even tried to get away from that cash bucket, I believe, with his client portfolios or with his firm's client portfolios. They feel that the cash is a pretty significant drag, which it
Yeah.
is. So they've tried to use non-cash assets to serve as buffer assets. So a reverse
Hopefully not
mortgage.
Bitcoin.
Right? No Bitcoin. But he used a 2 bucket setup. I've thought about a 3 bucket setup. And basically, the idea is that you've got your very liquid reserves, it may be 2 years worth of portfolio withdrawals in those cash reserves. Then you have another, say, 5 to 8 years worth of high quality fixed income assets. That's your bucket 2. And so with those 2 buckets, you've essentially built yourself a say, 10-year framework, bulwark, to protect yourself against some big equity market shock. And so if in a worst case scenario, you retire into a terrible bear market, say you retire into like 2000 and the market really doesn't fully recover for another decade, well, that gives you assets to spend through during those first years of retirement. So
Like
that's the
a
basic
cushion.
idea. Exactly.
So that has intuitive appeal to me. And I can attest, when I thought I was going to retire 2 years ago after I sold my business, I ended up not retiring. But the first thing is, I was amazed at how frightened I was to spend my money. Now, in fairness, I'm much younger than or not much younger, but I'm younger than I look. I look a lot older. But I was 52 then, so a fairly early retirement. And I was scared to death to spend any of our money. And so the bucket strategy really appeals to me. But I confess, I ran into some hurdles that I just couldn't clear in my mind. I guess before I get to them, sort of a precursor is this. If you go back to the 4% rule, with or without guardrails, however you set it up, your equity allocation is really important, right? I mean, Bengen looked at a number of allocations, but he basically settled in between 50 and 75% in equities. I think Guyton, Kitces, others that have, Dr. Fowle, others that have come since then pretty much agree with that. I kind of see 60 to 65% in equities. That's pretty rich when you compare it, I think, to a lot of traditional advice. Certainly when you compare it to like a target date retirement fund, I don't know of any that have that much allocated to equities by the time someone's enters retirement. But I wonder how, or if you've given thought to this idea of, if you're going to go with a bucket strategy, with a bucket strategy, you're allocating based on years of expenses, at least as I understand it. But don't you also have to make sure that whatever that turns out to be, you've got the right amount in the different asset classes? Does that make sense?
It does, although my preference is that the starting point for setting up the portfolio's asset allocation is, I don't know any other way that you would set up asset allocation than thinking about, well, first you'd want to stress test whatever spending rate you're using and make sure that that seems reasonable. But after that, it seems like the most logical way to asset allocate is to look at your anticipated spending from that portfolio and use that to drive how you invest your money. And that's one reason why I like this bucket strategy, in that it's really customizable. So an example I would give is, let's say we're talking about a college professor who has a full pension in retirement. And granted, that's a small share of the population, but say she's just planning to pull like $15,000 from her portfolio annually. Well, you can see that the net effect of that would be small bucket 1, because she only has $30,000 if she's doing 2 years worth of cash flows. Bucket 2, if that's another 8 years worth of portfolio withdrawals. That's also not large. The bulk of her assets
Yeah.
would be in bucket 3 in the growth bucket, which really makes sense given that she's just, sipping from that portfolio. She's not withdrawing from it aggressively. So
Yeah.
to my mind, it's just a really sensible way to come up with asset allocation framework that makes sense. And it's not at all black boxy. It's really driven by what are the anticipated portfolio withdrawals. For me, that just makes sense as a
Yeah.
structure.
So I've always envisioned it kind of like a waterfall with your equities up here, they flow into fixed income, and then they in turn flow into cash. I don't know if that's the right way to visualize it. That's how I visualize it. And I wondered, should it ever work in reverse? So for example, I get that you've got the cash and fixed income cushion, so that if the market's down 20%, you maybe leave your equity bucket alone, I guess. But that raises two questions for me. How long do you leave it alone? Right? I mean, do you wait until the market goes back up above where it was when it started to fall, or do you just wait until a year and when it's positive? And a related question is, when the market does fall, shouldn't you actually be putting more money into the stock buckets? Shouldn't my waterfall be flowing up and into the stock bucket if the market's fallen by whatever, 20%?
Yeah, lots of good questions there. So I think the key point is I wouldn't be dogmatic about it. I think sometimes people I have a slide that has bucket 1, bucket 2, bucket 3, and they sort of say, oh, I get it. I'm spending through those buckets 1, 2, and 3. No, 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 no. In a certain environment, bad equity market environment, yes, you probably would want to do that.
Okay.
But right now, for example, someone using the bucket strategy should be spending from bucket 3, or at least using it to replenish bucket 1 if it needs to be topped back up. You wouldn't want to be touching those, the bucket 1 and 2 in such a period. So I think the key idea is that with this strategy, at least in my implementation of it, you would stay really flexible. And so for a lot of retirees, from a practical standpoint, bucket 1 and bucket 2 are delivering at least some income. And so one way that you could think about it is, in a normal market environment, you're maybe getting like half of your cash flow needs just from the organically generated income from buckets 1 and 2. And then you're turning to rebalancing for any additional cash flow needs. So I think that that's a way to think about it, that you can use income plus rebalancing to help meet your cash flow needs on an ongoing basis.
That makes sense. So one last question on the bucket strategy. Given the low yields, does your fixed income bucket? I would be tempted to shrink it, just because I mean they're negative on a real basis. I think pretty much.
Right.
Any thoughts on whether the current yield environment should change or somehow influence the implementation of the bucket strategy?
You could possibly shrink it a little bit. One data point that I think a lot about, or I look at rolling returns from various asset classes, and we can do that in some of our software that we have at Morningstar. One thing we know about stocks is that if you have at least a 10-year horizon, stocks are extraordinarily reliable. But when you start to shrink that time horizon, certainly to like 5 years, stocks are way too unreliable. The prospect of having a negative return is just too great to deliver any sort of comfort. So that's where I gravitate to, say, 8 to 10 years worth of cash and bonds, because stocks over a, say, 10-year time period have been pretty reliable. Yeah. What I would urge investors not to do at this juncture is to be gravitating to higher yielding fixed income assets. I think that really worries me, because we've seen spreads between some of the lower quality, higher yielding fixed income assets really shrink. But the spreads between high quality fixed income assets and the lower quality stuff. So I just don't think you have a margin of safety there. I'd use them as kind of supporting players in my broader portfolio.
Yeah, it feels like there's just nowhere to go. I mean, it's like
Right.
you just have to accept the low yields. I mean, I've actually gone onto the very short end of the yield curve for the most part, but I don't have any bonds over intermediate term, and I don't have any high yield or emerging market debt. But there's just there's just nowhere to go, right? I mean, it's
No,
just
that's right. And we have worked on some data about correlations just recently among asset classes. And the interesting thing is the long-term government bonds historically had been kind of the place to be if you wanted equity market ballast, if you wanted something with the potential to go up meaningfully when stocks went down. More recently, we took a look at correlations and saw that short and intermediate term treasuries did just as good a job as long treasuries of serving as shock absorbers. So their diversifying abilities appear to be almost as good. So I don't see a strong purpose for long government bonds. And to the extent that you have high yield bonds or emerging markets, I like the idea of kind of putting them in bucket 3 of the
yeah,
portfolio, thinking of them as really long term, maybe equity surrogates, but not looking to them to be any sort of ballast in an equity
yeah.
market shock.
Do you think it's the shape of the yield curve that's causing short and intermediate term bonds to effectively function similar to long-term bonds in an overall portfolio? Is it because the yield curve is flattened more or less?
It may simply be that because the yield differential between
Yeah,
short and longer term bonds is so narrow today that
yeah,
it may just be causing a little bit of a change in that diversifying
right,
relationship that we
right.
had seen in the past.
Got it. Well, great. Well, listen, I really appreciate your time. This is great stuff, particularly for old folks like me who are wrestling with it. It's one thing to write about it when I'm 10 years away, but when you start to get close enough to start living it, it takes on new meaning. So really appreciate your time today.
Well, thanks so much, Rob. It's great perspective. It's been great talking to you today.